Yes, foreign investors have pulled out billions from Indian markets. And yet, right in the middle of all that selling, the same foreign institutions have been quietly and consistently buying some specific stocks every single quarter for 4 quarters in a row. Now, think about that for a second. If you were dumping everything else but still holding onto a few specific names, it means you really believe in those. So, today, we are going to find out exactly which 11 stocks smart money kept buying, what's actually happening inside these businesses, and whether there is a real opportunity for you as an investor or not. So let's go through each of these one by one. Let's start with stock number 1, which is BlackBuck. Did you know this? That India's trucking industry is one of the largest yet most fragmented in the country. Nearly 70 to 75% of truck operators own fewer than 5 trucks. Most of them still rely on phone calls, middlemen to run their business. So there is no real technology layer tying everything together. That's exactly the gap BlackBuck is stepping into. The company is trying to become the digital backbone for India's truck operators, handling toll, fast tag payments, GPS tracking, fuel payments, load matching, vehicle financing, all from one platform. And here's what makes the model clever. All these services go to the same customer base. So it doesn't keep spending money to acquire new users. It deepens its relationships with the ones it already has. Management shared that transacting users spend around 45 minutes per day on the platform. For a logistics utility app, that's unusually high. The biggest trigger right now is something called Superloads, which is their managed freight marketplace. Traditionally, freight in India is coordinated through offline brokers. BlackBuck wants to digitize that entire workflow end to end. Pricing, execution, collections, everything. They have expanded this from 4 to 9 cities and are still investing heavily behind it. Now let's look at the numbers quickly. At around 531 rupees, the stock is profitable with profit growth crossing 1000%. Sales growth near 47% and the company is almost debt free, trading at around 25 times earnings. And the FII holdings jumped from 11.7% to 32.4% in just a few quarters. That's a massive move. But yes, there are risks to watch. Superloads is still in playbook building mode. Managed logistics is operationally heavy. Execution intensity remains high. Now let's move on to stock number 2, which is Vishal Mega Mart. Everyone wants better clothes, better products, everything better. But affordability is still a real constraint for a lot of India's middle and lower middle class. Vishal Mega Mart is solving for that gap and making aspirations affordable. And it's actually working. Same store sales growth, which measures how much existing stores are growing, came in at 10.3% for the first 9 months of FY26. More importantly, nearly 70% of that growth came from more customers walking in, not from price hikes. That's genuine demand. What's also interesting is premiumization within affordability. Customers are gradually upgrading but staying within Vishal's ecosystem. Store expansion is aggressive too. They ended December 2025 with 771 stores across 517 cities, adding 80 new stores in just 9 months. And nearly 95% of revenue comes from registered loyalty customers, giving them a powerful data and cross-sell advantage. Valuation is around 117 rupees. The stock trades at about 70 times earnings. So the market is pricing in a strong growth premium. Revenue growing around 20%, profit growing around 36%. FII holding has moved from roughly 7% to over 22% in just 1 year. That's a serious ramp up. But yes, there are risks too. Value retail is execution heavy. Rapid store expansion, pricing pressure in smaller towns, and rising competition can put pressure on margins if not managed carefully. Now let's move on to stock number 3, which is MTAR Technologies. They make ultra precision components for clean energy, nuclear, aerospace, and defense. And customer qualification takes years in this category. So once you're a qualified supplier, you almost never get replaced. That's the moat. Now here's what changed recently. The demand is exploding. Management expects FY27 revenue growth of nearly 80%, which is mainly driven by global customers scaling up fuel cell and hydrogen applications. Now to support that, MTAR is putting 250 to 300 crore of capex in FY27 to expand manufacturing capacity. At around 7,345 rupees, the stock trades at 230 times earnings. Yes, that's a very high number. The market is paying a massive premium for MTAR's positioning. FII holding has moved from 6.7% to over 17% in 1 year, which shows conviction. But the risk here is real. Large projects have long qualification cycles, so revenue can be lumpy. The capex cycle adds debt, and business is still dependent on a handful of global clients. So, any delay from one client has an outsized impact. Now, let's move on to stock number 4, which is home first finance. There's a market that traditional banks have always found difficult to serve well. Think first time home buyers, particularly salaried and self employed individuals earning below 50,000 a month. Basically, people without a long credit history. Home First Finance was built specifically for this customer. And what makes it stand out is the technology behind the lending. Nearly 89% of loans are approved within 48 hours using AI based income assessment, centralized underwriting, and scoring models. Basically, fast, scalable, and precise. FY26 results were strong across the board. AUM grew 25% to 15,878 crore. Profit grew 41% to 540 crore. Return on assets stood at a healthy 3.9%, and cost to income improved to 32.5%, showing that as they grow, they are becoming more efficient, not less. Asset quality also improved. Gross NPA came down to 1.8% and overdue loan metrics improved consistently, which means the underwriting is working. Now at around 1076 rupees, the stock trades at 21 times earnings and 2.6 times book value, which is reasonably placed for a housing finance company of this quality. FII ownership moved from 36% to nearly 46%, which is already high and keeps growing. But there are risks. About 13 to 14% of borrowers are new to credit with limited repayment history. The loan book is still relatively young and hasn't been tested through a full economic downturn. And competition from larger banks and NBFCs in this space is also increasing. Underwriting discipline is everything here. Now let's move on to the next stock on the list, which is Shelly Engineering Plastics. If you've been following the GLP-1 or the Ozempic wave, this is a company that sits right in the middle of it. The global GLP-1 drug market is expected to grow from $18 billion to over $120 billion. These drugs need precision delivery devices, which is pen injectors. And Shelly Engineering makes exactly those. The company specializes in precision plastic components for healthcare and medical devices. This is a regulated, high barrier segment where customer relationships are long term and hard to replace. They also have a massive strategic move underway, a manufacturing facility in Abu Dhabi, and they are targeting to build a capacity of 75 million pen injectors per year. This is expected to go live by Q4 FY28. On top of that, 75% of revenue already comes from exports across 40 plus countries. So, good global diversification. The stock is near its 52-week high of 2,839 rupees and trades at around 90 times earnings, so the market has already priced in a lot of optimism. FII holding moved from 7.4% to nearly 17% in 1 year. But the key risk to understand here is this entire story is built on the GLP-1 wave continuing at scale. If customer approvals slow down, drug delivery technology changes, or commercial timelines slip, that Abu Dhabi capacity could sit underutilized and hurt returns. Now let's look at the next stock, which is Polycab. Polycab started as a wires and cables company. Today, it's becoming something much bigger, almost a proxy for India's entire electrification story. Every solar farm needs cables, every new home needs wiring, every data center, factory, metro line, all of it runs on electrical infrastructure. And Polycab is right at the center of all of it. Management has also highlighted healthy demand from government infrastructure projects, private real estate, and industrial capex. The scale advantage here is massive. Polycab today operates one of the deepest distribution networks in the industry with more than 3,900 authorized dealers, 26 warehouses, and over 2 lakh retail touchpoints across India. In this industry, distribution is the moat. Electricians and contractors stick with brands they trust and can find anywhere. Beyond cables, Polycab is also building a presence in consumer electricals, that is fans, switches, lighting, appliances, to its FMEG segment. Margins here are lower for now, but it creates real long-term optionality as the brand builds. Financially, the discipline is impressive. ROC above 34%, almost zero debt, and strong cash generation. This is rare for a manufacturing heavy business. At around 9,218 rupees, the stock trades at 52 times earnings, reflecting its market leadership and the sheer scale of India's infrastructure opportunity. FII ownership has grown from below 10% in mid 2023 to over 18% by March 2026, a steady multi year build up. Now, the two risks to keep in mind are scaling the FMEG business profitably is harder than it looks, with intense competition from established brands. And copper and aluminium price swings can temporarily pressure margins and channel behavior. Now let's look at stock number 7, which is GE Vernova. India is adding record amounts of solar and wind energy. But how does all that power actually reach homes and factories and to you? It has to travel through transmission lines. And for long distances, you need a technology called HVDC or high voltage direct current. It's the most efficient way to move large amounts of power over hundreds of kilometers. That's exactly where GE Vernova operates. The company makes HVDC systems, transformers, grid substations, and automation equipment, basically the critical infrastructure that moves renewable power from remote locations like Rajasthan and Gujarat to demand centers across India. This is again a high barrier business. You can't just show up and start selling grid infrastructure to governments. It takes deep technology, proven track records, and years of relationship building. And the numbers are already showing the momentum. In Q3 FY26, order inflows grew 41%, revenues jumped 58%, and the order backlog reached nearly 14,400 crore rupees, giving strong multi-year visibility. EBITDA margins expanded to nearly 27%, and there is zero debt. Then there is the Khavda South All Pad HVDC project, which is one of the largest in the country. This will also start entering the order book in the upcoming quarters. That's a big catalyst. Plus, global demand is growing too. The company is supplying across Europe, Middle East, and Africa. Then, AI infrastructure growth worldwide is creating fresh demand for grid equipment. Even at around 4,350 rupees, the stock continues to trade near 100x earnings because the market is pricing in GE Vernova's strong positioning in India's long-term transmission and power infrastructure build-out. And it's backed by strong order visibility and real entry barriers. FII holding moved from 14.5% in June 25 to more than 20% by March 2026. The risks here are real too. Large grid projects are complex. Delays in government orders, execution bottlenecks, or supply chain issues can slow revenue conversion. At this valuation, there is little room for that. Now let's look at stock number 8, which is Hitachi Energy. It has become one of the strongest institutional plays on India's transmission and energy transition cycle. India is targeting over 500 gigawatt of renewable capacity, and none of that scales without grid infrastructure. And Hitachi operates in HVDC transformers, GIS substations, and grid automation, very similar high entry barrier territory as GE Vernova. What's improved meaningfully is execution visibility. Order backlog has reached nearly 2,500 crore against annual revenues of around 2,120 crore. So they already have more than a year's revenue sitting in backlog. Recent performance is also accelerating. Revenue grew around 30%, profit jumped over 90%. This shows clear operating leverage as the business scales. A newer trigger is the AI and data center demand. Hyperscale data centers need highly stable power systems that respond to fluctuating loads within seconds. That's creating a fresh, long duration demand category for advanced grid companies. Exports are becoming another major growth engine. India is becoming a key manufacturing hub for the parent company as global demand for transformers remain tight. Even at around 32,180 rupees, the stock trades at nearly 160 times earnings and over 30 times book value, showing how the market is pricing in significant future growth. Now let's look at the FII ownership. It moved from 7.2% to nearly 11.7% over the last several quarters. But yes, there are risks. At these valuations, execution has to be flawless. Any delay in project delivery or margin pressure from rising input costs will matter a lot. Now let's move on to stock number 9, which is GMR Airports. Now GMR Airports is becoming one of the biggest players in India's growing air travel story. And it is not just an airline terminal business anymore, it's becoming a large commercial ecosystem built around airports. Delhi, Hyderabad, Goa, and internationally in Philippines and Greece. The network is expanding. The big turning point came in April 2025 when Delhi Airport's tariff revision kicked in. That single event changed the earnings picture dramatically. In Q3 FY26, EBITDA jumped nearly 65% and margins expanded to almost 55%. That's what operating leverage looks like when traffic and tariffs move together. Passenger traffic remains strong across GMR's airport network, with Delhi Airport alone handling nearly 80 million passengers in FY25. But the bigger profit driver is the non-aero revenue: duty-free, retail, lounges, food courts, advertising. Delhi Airports non-aero revenue crossed 2,700 crore in just 9 months of FY26. Another major trigger is airport city monetization. GMR controls over 2,500 acres of land. This creates long-term opportunities across hospitality, offices and logistics and commercial real estate. The re-rating is already visible in the stock price. The stock moved from 79 rupees to above 110 before settling around 96 rupees. Even after that move, FII ownership increased steadily from 15.1% in March 25 to over 20.1% by March 26. The risks here to watch are debt, which remains elevated at over 41,000 crore. The business is highly dependent on passenger traffic, so any sharp rise in airfares, fuel costs, or broader slowdown in travel demand can directly impact the business. Now, let's look at the 10th stock on this list, which is BPCL. Now, at first glance, BPCL might seem like a boring oil company, but look closer and there's a lot more going on. The company already operates at an enormous scale, over 4.4 lakh crore in revenue and nearly 7,500 crore in profit. Refinery utilization is at 119% and refining margins at $13.25 per barrel, which is among the best in the industry. But the real story is what's coming next. BPCL is planning to invest nearly 1.7 lakh crores over the coming years across refineries, petrochemicals, pipelines, gas and renewable energy. The standout project is the 50,000 crore Bina Petrochemical Complex, which will scale up petrochemical capacity from 0.83 to 3.2 mmtpa by FY29. And more petrochemicals means a better product mix and structurally higher margins. Gas and green energy are also scaling rapidly. BPCL is targeting 10 gigawatt renewable capacity by 2035. They are also aggressively building EV charging infrastructure, which has already crossed 6,500 charging stations, and its city gas business already covers roughly 25% of India's geographical area through JVs. The stock has corrected from nearly 390 rupees levels to around 295 rupees, but institutions have kept buying through the decline. FII ownership increased consistently from 15.4% in June 25 to nearly 19.6% by March 26. Valuation also remains attractive relative to the scale of the business. The stock trades at nearly 5 times earnings and around 1.3 times book value while offering close to 6% dividend yield. But yes, there are risks too. Global crude and refining margin volatility is the single biggest risk. Any sharp spike in oil prices or geopolitical disruption in West Asia directly hits profitability. Now let's look at the last stock on this list, South Indian Bank. This one is a classic turnaround story and it's still not fully priced in. A few years ago, South Indian Bank had weak asset quality and inconsistent profitability. Today, it looks like a fundamentally different bank altogether. GNPA has fallen to just 1.43%, net NPA is at 0.29%. Provision coverage is at 94%, and nearly 88% of the old stressed loan book has already been replaced with a cleaner portfolio. Growth is also coming from the right places now, not risky corporate loans but retail. Gold loans are up 46%, mortgage loans up 43%, and auto loans are up 21%. Technology is also improving fast. 98.5% of transactions are now digital, and AI-led systems are being used across lending, collections, and customer service. Now, financially, FY26 net profit hit a record 1,455 crore, return on assets crossed 1%, and capital adequacy at nearly 20%. Now, the interesting part is, despite all this improvement, the stock still trades below book value at 0.9x, around 38.5 rupees. The market hasn't fully believed the turnaround yet. FII holding moved sharply from 17.6% to over 24.2% in just a few quarters. The risks here are gold loan growth and unsecured lending can be more volatile during economic downturns. Margins could stay under pressure if rates stay high. And since this is a turnaround, consistency over the next 2 to 3 years will determine whether the re-rating really happens. So there you have it, 11 stocks, all of them seeing consistent FII accumulation, even as they were selling everything else. And when you zoom out, the pattern is very clear. Smart money is positioning around power infrastructure, energy transition, precision manufacturing, affordable consumption, and retail lending. These aren't random bets. These are long-term structural themes that FIIs believe will play out over years, not quarters. What I find most interesting is this. The buying is happening quietly, steadily, and against the tide of broad FII outflows. That's usually when the highest conviction calls get made. Now, does that mean you should blindly buy all of these? Absolutely not. Some of these valuations are pricing in near perfect execution. There is no margin for error at those levels. And the risks we discussed are real, not just fine print. Do your own research, understand what you're buying, and invest with conviction, not just because someone else is buying. If you found this useful, share it with someone who's thinking about where to invest in India right now. Also, tell us which of these 11 stocks did you find most interesting. See you in the next one.